这个不是我们正式的会员节目啊，我只是准备听 Upstart 的财报，看着好像不错，我们可以一起来听一下。所以我们如果简单看它的财报，我觉得会员应该很清楚啊。我之前讲过很多次了，我说现在它的问题主要是两个嘛，就是我们要从它的财报和电话会议里面要知道两个重要的信息。第一个就是它的长期的那种稳定资本到底有什么进展这个现在明确的，它在这个财报的就是这个 release 里面已经讲了，他说我们现在已经确定了多个的长期的合作伙伴这些给我们提供大概20亿美金在未来的12个月之内所以这是它的收入的一个很重要的保证。那如果从它第一季度的财报来看的话也比想象中，至少比它之前预期的也要好一些。收入是103个 million，103个 million 不算多但是呢也不差比去年是少了很多。但是它的费我们之前讲过，这个费呢是它真正的收的使用费它我们前面可以不用听。所以这个117，这也是比预想要好。最重要的是，它下个季度的预期是费是130，比这个季度要提高。而且很重要是说，它的另外就是那个net interest income， 就是之前的都是减项，这个季度终于像我们讲的变成了加项，变成加5个 million。而且下个季度基本上没有烧钱了。他说，调整过的 EBITDA 是0，所以就是说基本没有现金的消耗。OK， 所以我们在听他我觉得主要另外一个我感兴趣就是他对汽车这部分新车贷款的管理层有什么具体的指示。所以我们一会儿就主要可能是看他这个资金的成本以及他的汽车的新车贷款的一些管理层的指示。OK， 那我们现在就开始听了。听完之后，然后今天白天我还会做会员的视频，然后也会做Affirm 的另外一期视频，至少2个。然后如果有问题，大家可以在会员视频下面留言，我会尽量在周日的会员直播里面给大家具体的回答大家可能的问题。OK， 那我们现在开始听。
And are reconciled to our GAAP results, which can be found in the earnings release and supplemental tables. To ensure that we can address as many analyst questions as possible during the call, we request that you please limit yourself to one initial question and one follow-up. Later this quarter, Upstart will be participating in the Barclays Emerging Payments and FinTech Forum on May 17th, and the Bank of America Global Technology Conference, June 7th. Now I'd like to turn it over to Dave Gerard, CEO of Upstart.
Good afternoon, everyone. Thank you for joining us on our earnings call covering our first quarter 2023 results. I'm Dave Gerard, co-founder and CEO of Upstart. Despite the headwinds facing our industry in early 2023, I'm pleased with the progress we made against the objectives that I set out for you previously. I'm hopeful that as we move through the year, you will come to see Q1 as a transitional quarter for Upstart. While the economic environment remains turbulent, there are many reasons to be optimistic about our future. I assure you, we aren't waiting around for the economy to improve. First, our development teams made giant leaps forward in each of our main product areas. Innovation in AI is the primary source of Upstart's competitive advantage, and we continue to break new ground in this area. I'll share more about these wins shortly. Second, we accomplished this while taking significant fixed costs out of our business. Last quarter, I told you that I'm committed to running an operationally and fiscally tight ship. Given our concerted efforts in Q1 to reduce both payroll and operational expenses, I'm confident that Upstart is now a more streamlined and efficient company, setting us up to return to profitable growth soon. I'll share more about our cost reduction efforts later. And finally, I'm pleased to tell you that we secured multiple long-term funding agreements, together expected to deliver more than $2 billion to the Upstart platform over the next 12 months. This is a critical first step toward building resiliency and predictability into our business. Together, I believe these efforts put us in a stronger position regardless of which direction the economy turns. Our own analysis, which we launched publicly in March in the form of the Upstart Macro Index, or UMI, suggests that the financial health of the mainstream American consumer deteriorated rapidly through the first 9 or so months of 2022, but has since stabilized, if not improved, for the last several months. The personal savings rate, which may be the most relevant predictor of UMI, bottomed out mid-last year at 2.7% and has increased to 5.1% since then. Since late 2022, loans on our platform have been priced conservatively relative to UMI, so our bank and credit union partners can feel confident that recent vintages are today performing at or above expectations. And while banks are certainly treading carefully in the current environment, many lenders and institutional investors appreciate the combination of high yield and short duration that Upstart-powered loans offer. Irrespective of the environment, I push our team very hard to make sure Upstart improves constantly in 4 critical dimensions. First, best rates for all. We founded Upstart to improve access to credit, so delivering the best rates possible to all consumers will always be our true north. Given the breadth and diversity of competition, we'll never 100% achieve this goal, but in a fierce effort to do so, we can become the market leader in a vitally important segment of our economy. Better rates are unlocked first and foremost by a more accurate and predictive credit model, one that excels at separating good risk from bad, and AI is the key to this. Our models are today trained on more than 100 billion cells of performance data. And now, with an average of 90,000 new loan repayments due each day across all our bank partners, the system is learning and adjusting in near real time to actual loan performance. We pushed 23 new and improved versions of our AI model into production during the first quarter alone, about 1 every 3 days. We're confident that our AI has never been as sophisticated or as accurate as it is today. But in order to deliver the best rates for all, we also need a diversity of bank and credit union partners, each with different priorities, business objectives, and balance sheet issues to solve. Today, we have almost 100 such partners, an order of magnitude more than the 10 we had when we went public in December 2020. We additionally need a strong presence and reputation in institutional and capital markets, because the limited risk appetite of bank balance sheets will never serve the needs of the entire U.S. credit market. This quarter, we expanded our roster of institutional partners in ways that should help us deliver quality offers to consumers through all parts of the cycle. Second, more efficient borrowing and lending. Every quarter, we aim to make our platform more efficient for consumers and bank partners. This improvement comes from better AI, which enables more sophisticated risk models, which in turn enable a faster and more efficient experience for consumers and lenders. In the first quarter, we achieved a record level of automation with 84% of Upstart-powered loans fully automated across all our bank partners. By this, I mean the loans were approved and verified instantly, with zero human intervention from rate requests through loan funding. We know of no other lending marketplace with this level of automation. This instant and automated process, which by the way 70% of consumers access by a mobile phone, creates an unparalleled wow moment for the borrower, who is often surprised, if not shocked, to realize that there are no more steps in the approval process. Because consumers rightfully value their time, this delightful moment is often more impactful than the specific rate our bank partners offer. Efficiency is obviously important for the lender as well. Our bank partners' Upstart-powered lending programs are open for business 24 hours a day, 7 days a week. In addition to providing the modern, all-digital experience their customers expect, banks can tailor their Upstart lending programs to precisely target their business objectives, risk appetite, and balance sheet needs. When it comes to routine transactions like offering a loan, branch hours are inconvenient, human intervention is costly, and consumers just want what they want when they want it. Third, more resilience. After all we've experienced in the last year, I'm keenly aware that we need to build more resilience into Upstart's business. Lending is inherently cyclical, but we aim to build a platform that largely mitigates that cyclicality, ensuring that credit continues to be available and flowing when it's needed, albeit accurately priced to prevailing conditions. Central to this resilience is securing a baseline supply of long-term capital that we can depend on through the market's ups and downs. As I mentioned earlier, we've completed agreements with multiple strategic partners as of today and will continue to explore additional partnerships. Our primary goal is to have loan funding capital committed at a level that allows us to remain cash flow positive through typical market cycles. Resilience also comes from a flexible business model with lower fixed costs, proven pricing power, and durable unit economics. We've always been a capital-efficient business, raising and spending a fraction of what peer companies spend. But there are always more ways to drive efficiency. Between Q4 and Q1, we took the necessary steps to reduce Upstart headcount by almost 30%. While clearly a gut-wrenching decision, it will allow us to return to profitability at a significantly lower loan volume and has led us to be more focused and nimble in delivering our product roadmap. We also identified opportunities to reduce our technical infrastructure costs by as much as $10 million annually and sublet some unnecessary office space, both of which will go directly to the bottom line. On the revenue side, we flexed up our take rates, delivering a record contribution margin of 58% in Q1. Our prior record contribution margin was 54% in Q3 of 2020. Our strong and flexible unit economics are a byproduct of the competitive advantage provided by AI. All these together position us well to navigate whatever twists and turns lie ahead, while strengthening our position for the inevitable sunnier markets to come. The last important lever on resiliency is our product offering itself, which I'll speak to now. Fourth, a broader range of products. Moving beyond our core personal loan product is critically important to reaching our potential as a business. Offering a wider range of solutions makes us more relevant to more consumers and also more valuable to our bank and credit union partners. Product and borrower diversification can also provide greater resilience through future market cycles. We continue to make progress in our second big bet, the auto lending market. This market has had what may be the most tumultuous 3 years in its 100-plus years history. Despite this, we've made rapid progress with our products and couldn't be more excited about our potential. Since our last earnings call, we announced that both Acura and Mercedes-Benz approved Upstart as a digital retail provider, becoming our 8th and 9th OEM partners. We recently launched a new and improved AI model for our auto retail lending product that builds off our existing auto refinance model. We now consider both of these models calibrated and performing on target. Our footprint of dealers piloting our lending product expanded to 39 since last I updated you, and we expect this rollout to continue throughout the year. We also signed our first external funding agreement for auto retail, which is an important milestone to us. And lastly, we're making rapid improvements to our servicing and collections of auto loans, which accrues directly to model performance. I'm also pleased to let you know that we expect to launch a home equity product later this year. This is a great fit for Upstart for a few reasons. First, 95% of HELOCs are financed by banks and credit unions, so it's an asset our lending partners know and value. Second, HELOCs naturally serve a very prime consumer, namely homeowners. We expect Upstart's HELOCs to have annual loss rates less than 1%. And third, home equity products tend to be counter-cyclical to refinance products. We know this because in Q4 2022, HELOC volumes grew 32% year on year, even while mortgage refinances plummeted. Importantly, there's a lot of opportunity to improve the process of originating HELOCs. The average HELOC today takes 36 days to fund, while we're aiming for online approval in 10 minutes and funding within 5 days. Lastly, I have to mention the incredible progress made by our small dollar loan team. By way of context, banks feel pressure from regulators to eradicate overdraft fees and instead to provide affordable relief loans to consumers who have short-term cash needs. But they've struggled for years to do this both meaningfully and profitably. Short-term loans of a few $100s to existing customers or even to random walk-up consumers at rates within the APR limits for nationally chartered banks has seen beyond the reach of the banking industry. Well, we're building it for them, and we believe it has the potential to eradicate more than 70% of payday loans in the next 5 years. Our small dollar product already has 90% automation rate, far beyond even our core personal loan product. And in Q1, we launched a new AI model for this product that delivered the largest single accuracy improvement measured in our history. We've also expanded the offering to include loan terms as short as 3 months, which drove a 37% increase in approval rates. I'm not sure we've ever delivered a product with as much impact and as much alignment with our mission as we're seeing from the small dollar team. To wrap things up, I want to acknowledge that the financial industry is not out of the woods yet. But even in this challenging economy, I believe Upstart is in position to grow reasonably through our typical run rate of model and technology improvements. And when the banking and credit markets eventually normalize, as surely they will, the true strength of our platform will become clear to all. Upstart's success will continue to be built on excellence and leadership in AI. By this, I mean the speed with which we can develop, deploy, and calibrate new and more accurate AI models. Together with the amazing quality of our team, it is this that makes me optimistic about Upstart's future. Thank you, and I'd like now to turn it over to Sanjay, our Chief Financial Officer, to walk through our Q1 2023 financial results and guide. Sanjay?
哇，太多好消息了，不知道明天开盘之后这个股市会怎么反应。
At a headline level, over the past quarter, we've observed continuing stability in consumer repayment trends on the borrower side of our platform, counterbalanced by heightened volatility in the banking and institutional funding markets. In U.S. consumer personal finance, a couple of virtuous trends continue to unfold in the aggregate statistics. The percent of adults participating in the workforce continues to climb steadily as our population returns to work, and the average personal tax burden for each individual has fallen considerably since last year, together leading to a rising level of real disposable income per adult. On the expenditure side, real consumption per capita continues to moderate and creep back into line with disposable income. Rising disposable income and moderating consumption expenditures are resulting in a personal savings rate that has now risen in each of the past 6 months, since bottoming out last September. This particular indicator has demonstrated a strong correlation to borrower repayment health since the pandemic, and we are seeing this reflected in our Upstart Macro Index, which peaked last October and is showing signs of early recovery. The ongoing improvement in the consumer fiscal condition, together with the recalibration of our own underwriting models, is resulting in loan performance that, as of our Q4 vintages, we believe is on track to deliver unlevered gross returns of approximately 11% as a blended average across the banks, credit unions, and institutional buyers on our platform. Conversely, the funding side of the ecosystem remains challenging in the current climate. Increased conservatism among existing lending partners in the wake of the recent bank failures has enhanced our headwinds, even as we have brought additional volume onto the platform through implementation of new bank partnerships. The banking sector turbulence has also contributed to wider market spreads on high-yield debt after a brief period of moderation in January and February, which is in turn causing institutional investors who rely on functioning ABS markets to be increasingly cautious in their deployment of capital. We have managed to more than offset these headwinds by securing multiple longer-term funding agreements, which we expect to deliver more than $2 billion in capital over the coming 12 months. We believe that these deals, as well as others in the pipeline, will provide us with a stronger and more resilient capital supply over the coming quarters. With these items as context, here are some financial highlights from the first quarter of 2023. Revenue from fees was $117 million in Q1, coming in above our guided expectation as a result of some increased funding secured through our longer-term capital arrangements, as well as ongoing take rate optimization. Net interest income was slightly below guidance at negative $14 million, largely a result of unrealized fair value adjustments informed by the economics of a balance sheet transaction that was expected to close after the end of the quarter. Taken together, net revenue for Q1 came in at $103 million, slightly above guidance and representing a 67% contraction year over year. The volume of loan transactions across our platform in Q1 was approximately 84,000 loans, down 82% year over year, and representing over 53,000 units. Average loan size of $12,000 was up 22% versus the same period last year. Our contribution margin, a non-GAAP metric which we define as revenue from fees minus variable costs for borrower acquisition, verification, and servicing, as a percentage of revenue from fees, came in at 58% in Q1, up from 47% last year and 3 percentage points above our guided expectation for the quarter. We continued expanding our margins in Q1 through higher rates of automation, which attained a peak of 84%, improved marketing efficiency, and increased take rates. Operating expenses were $235 million in Q1, down 15% year over year, but up 14% sequentially due to one-time restructuring costs incurred as part of our reduction in force, as well as a one-time non-cash charge resulting from the cancellation of a single executive performance-based equity award, which accounted for approximately $40 million of the overall expense base in this past quarter. The majority of the year-over-year reduction was achieved through sales and marketing, which declined by 76% following the trend in volume. We continue to limit hiring to only a handful of key strategic positions. Altogether, Q1 GAAP net loss was $129 million, and adjusted EBITDA was negative $31.1 million, both comfortably above our guided numbers. Adjusted earnings per share was negative 47 cents, based on a diluted weighted average share count of 81.9 million. We ended the quarter with loans on our balance sheet at $982 million, down sequentially from $1.01 billion the prior quarter. Of that total, loans made for the purposes of R&D, principally within the auto segment, represented $493 million of that total. Our corporate liquidity position remains strong, with $452 million of total cash on the balance sheet and approximately $632 million in net loan equity at fair value. In our remarks of last quarter, we expressed optimism that the consumer trends impacting credit appeared positive to us, and that the worst was likely behind us, and this is indeed what we have perceived over the last 90 days. Consumers reducing expenditures indicates to us that they are overspending less relative to income. Decreasing numbers of job openings in the economy indicates to us that Americans are returning to work. While both of these dynamics could be interpreted as a prelude to economic slowdown, it is clear to us that both have been beneficial for credit. This continues to be our perspective as we look to Q2. We also expressed confidence last quarter that through a combination of margin expansion, workforce reduction, and expenditure control, we could create a path to return to EBITDA break-even at our current lower scale. And indeed, we now anticipate achieving this in the second quarter. While painful, the workforce reduction was carried out with minimal impact to the velocity at which we are developing our newest round of bets in auto lending, small dollar loans, and HELOC, all areas in which we look forward to sharing more updates in the coming quarters. With these specifics in mind, for Q2 of 2023, we expect total revenues of approximately $135 million, consisting of revenue from fees of $130 million and net interest income of approximately $5 million. Contribution margin of approximately 60%, net income of approximately negative $40 million, adjusted net income of approximately negative $7 million, adjusted EBITDA of approximately 0, and a diluted weighted average share count of approximately 83.1 million shares. We are happy to be signaling a return to sequential growth and cash profitability in the current market environment. Our improving guidance is clearly not deriving from obvious improvements to the macroeconomy just yet. It is flowing from a combination of tenacious execution, operating discipline, margin expansion, and deal making. As always, a huge note of gratitude to the various Upstart teams who have been heads down and laser focused on getting us through the storm, and who have remained resolute over the past year in the face of such challenging external circumstances. While there may yet be a few more twists and turns along the way, we are optimistic that we have weathered the worst of it, and barring any reversal in consumer trends, that we are back on an ascending flight path. With that, Dave and I are happy to open up the call to any questions.
财报应该是完全没有问题了，解决了我之前的两个，一个就是它的资金的问题，另外一个就是汽车的贷款，而且管理层讲了，它马上要进入房贷市场，所以比我想象中还要快。所以股价应该有很好的反应。
Hi, Dave. Hi, Sanjay. Thanks for taking my question, and congrats on a pretty good quarter here. I was wondering, could you give us a little bit more detail around the long-term funding commitments, perhaps, and how we should think about how that might be applied or flow through for the remainder of the year? Are there any constraints, product categories it's focused on, or anything like that we need to know about? Thanks.
Yeah, thanks, Simon. This is Sanjay. Let's see. I mean, I guess I would say upfront, each agreement is a bit bespoke, so it's hard to sort of broadly generalize. But maybe a couple of headline thoughts. First of all, I would say these agreements, they more or less flow from the ability we've demonstrated over the past couple of quarters to be expansive with our margins and to improve our take rates. And because we have expanded margins, really the way to think about these agreements are we're able to sort of share some modest preferential economics with long-term committed investors. Those preferential economics could take the form of sort of return premiums or take rate co-investment or modest discounting and risk sharing. All investors have a slightly different set of preferences and objectives, so it tends to be a bit different by the counterparty. They're all currently focused on personal loans, so they're sort of restricted to our core business. Beyond that, they tend to mirror our broader institutional programs. So apart from some preferential economics that essentially flow from our enhanced unit economics, they tend to look very similar to what we would normally do through the capital markets.
Great, that's really helpful. Thank you. And maybe a follow-up question to that, just on your comments around take rate and I guess the very impressive contribution margins that you generated this quarter and anticipate to generate in next quarter. How should we think about the sustainability of that as you go through perhaps an economic recovery and loan acceleration at some point? Should we expect those contribution margins to decline? And then what does that mean in terms of, I suppose, those funding commitments become less important in that regard, but just like to think about how all that ties together.
Sure, yeah. I mean, I guess the punchline is I think they're probably sustainable for as long as we want them to be. There's really two underlying factors I would point to. One is the extent to which we are sort of investing for the short term versus the long term, and the other is the general elasticity of the loan demand on the borrower side. So currently, as an example, inelasticity is quite high. Credit is in demand on the borrower side, and so that creates sort of pricing ability on our side. But maybe the more important thing is when we're sort of solving for the near-term P&L, we are optimizing take rates as much as possible against that inelasticity, and we are managing our marketing programs to deliver loans that are profitable in the near term. I think that as the economy evolves and certainly as it improves, what you would see is, on the one hand, a declining inelasticity, so there'll be more sort of provision of credit on the supply side, and so borrowers will have more choice. But the other factor would be, in our case, we would then start to rebalance how we trade off the short term to the long term. And so by reducing take rates and by growing marketing campaigns, we can generate more volume, harvest more lifetime value of the customer, harvest more gains on the model learning side, things that won't necessarily show up in this quarter's P&L, but may provide value over time. And so when you put all of that together, you get an improving economy. I think you'd probably see take rates that may not go back to where they were before, but would probably moderate with the economy improving.
Thanks. That's really helpful. Thank you.
Our next question comes from the line of Ramsey El-Assal with Barclays. Please go ahead.
Hi, this is John Coffey on for Ramsey. I had a question for you on your slide 18, really regarding your conversion rates. So it looks like your conversion rates had declined from about 21% last year to 8%. I was just trying to understand the drivers of this a little bit better. Is most of it just the supply of credit, or is this sometimes that potential borrowers are hitting that ceiling for interest rates, or they're deciding to defer some kind of purchases till later on when they're maybe in a little bit more of a stable economic condition?
Yeah, hey John. It's got it doesn't have much at all to do with the supply side. I think maybe the single most explanatory variable would be what we call our Upstart Macro Index, or UMI, which is also in our investor materials. And that basically reflects the fact that, apples to apples, the same consumer is defaulting at a rate that is, maybe sort of 2 to 3 times higher than they were in mid-2021. And because of that, consumer repayment pattern change, we're pricing loans very differently, right? We're including much higher default premiums in the loans. And then compounding that, of course, is the higher base interest rates, which are requiring investors to demand higher sort of returns. When you add those two up, our like-for-like price for a loan has gone up, quite dramatically, and in some cases, 1,500 to 2,000 basis points. And because of that change in pricing, 2 things are happening. One is a lot less borrowers are getting approved, right? So, a lot of them are being pushed above the 36% APR threshold. And then even for those who are still getting approved, their prices are a lot higher and maybe less predisposed to taking the loan. So those 2 things combined have resulted in the contracting conversion rate.
All right, great. Thank you. And just for a very short follow-up, I noticed that your loans on your balance sheet actually declined a little bit quarter over quarter. Should we think of last quarter, the fourth quarter, as a bit of a high watermark, or is that still too early to say?
Good question, John. I mean, I think that continue to think of the balance sheet along the lines of the parameters you've expressed to the market, which is, there's a certain number we won't go above, and that's probably roughly where we were last quarter. We also sort of said in our remarks that there is a transaction that did not complete in Q1, but we expect it to complete in Q2, and that will bring our balance sheet, down next quarter. Now, from there, we may sort of continue to use the balance sheet as a platform tool, but I think that you'll probably see us remain sort of in a volume where we are sort of peaking at the $1 billion range, and then ebbing or flowing from there based on whether we're transacting or accumulating.
Great, thank you.
哇，他刚才说那个个人贷款的有些客户拿到的是比之前高20%的贷款，所以他的利润非常高的，也是为什么现在这么困难拿贷款。
I just want to understand, are these funds like securing minimums from existing partners, or is it incremental from new funding partners? If you could just provide a little bit more color on that and how it is compared to the existing run rate, I guess, of business they have.
Sure. Yeah, thanks, Pete. This is Sanjay. I think a lot of it is coming from partners that are new to the platform that we've never worked with before. Some of it is coming from existing partners who had either sort of stepped away from funding during the turbulence the past few quarters and are coming back to the platform, or they're re-upping in significant size and committing forward in exchange for a longer-term agreement. So I think in almost every case you can view it as sort of being additive to what we've been doing recently, and it sort of underpins both the improving guide that we have in our Q2 numbers, as well as its sort of more general optimism we're signaling qualitatively.
据说新拿到的这些长期资本，多数是新增的，是incremental， 并不是现在的收入，是未来的增项。
I guess in the current, assuming the status quo environment, like how do you think these model changes will influence results in the coming quarters? Thank you.
Hey Pete, this is Dave. I mean, generally speaking, on the margin, the upgrades to the AI tend to improve automation or improve accuracy of the models, and those tend to be in aggregate positive to growth. So as I was kind of saying toward the end of my remarks, you know, we believe we can grow without the economy improving, but it will certainly, you know, be doing it against what is currently a pretty challenging economy with respect to funding markets, you know, base credit rates, interest rates, et cetera. So, but we do believe, I mean, the reason we've been able to grow and over time is predominantly because the technology and the models get better, and those tend to lead to growth. And even in a difficult environment as we have today, that it's still true.
Okay. Thank you. Thank you both.
Thank you.
Our next question comes from the line of Juliana Bologna with Compass Point. Please go ahead.
I was curious in looking at kind of the mix of bank versus non-bank and the institutional investors on the platform. I'd be curious if there's a sense of like where that mix may have shifted this quarter, where that might go going forward.
Hey, Juliana. You're asking about the sort of mix of banks versus institutional investors?
That's right, yes.
Yeah, I mean, I guess, look, at a headline level, I would say that obviously the events that we went through in March that particularly impacted the banking sector definitely had an impact. And so the dynamic there is, you know, we continue to bring new sort of lending partner, bank credit union partners aboard, but existing ones are obviously becoming a little bit more conservative. I think that impacted capital markets less so. So you may have seen a bit of a shift towards the institutional dollars. How that plays out forward is a bit hard to tell. I mean, the banking sector is obviously right now in a bit of turbulence, and that may increase or it may moderate. And I think depending on you know what that sector experiences over the coming quarters, you know, you'll probably see reflected in their ability to or their appetite to lend and to take more balance sheet risk.
That makes sense. And then kind of looking for some of the past disclosures, you talk about two banks that seem to be the primary enablers of the loan sales or kind of the marketplace side of the platform. But if you add up the volumes of those two banks, it seems to imply that they're actually much more than the loans that are being sold to the institutional investors and retained by Upstart. And it could imply that, you know, one or two of those banks accounts for, you know, 50 plus or even close to 60% of all of your kind of bank funding side of the platform. So I'm curious, you know, what level of concentration there is on the bank side of the funding platform. Have you seen any of those partners pull back in their buying activity recently?
Yeah, there are really three banks on our platform that serve as conduits where they originate loans. In some cases, they hold some of them. In other cases, they end up selling them to institutional partners. So there are three of those banks on our platform, and it's quite possible to move volumes between them. It's quite purposeful that we can do that. Generally speaking, the fees and the profits on the loans that end up in the institutional side are higher than they are on the bank, what tend to be the primer loans that banks are originating and holding on their balance sheet. So that sort of creates the structure that you're seeing there. But it's not really, you know, in a true sense of revenue concentration. These are, again, many institutional buyers behind those banks, but we do have multiple what we call marketplace lending partners on the platform.
这就是我一直解释，像 Crossroad 这些 bank 不是真正的他的客户啊，所以他们不是银行伙伴，这是同样的问题。
Yeah, Giuliano. Yes, I think what you'll see in our revenue concentration disclosures when the financials come out is that those concentrations are going down. And I think in terms of, source capital dependency, I don't think anything is far greater than the ballpark that you just mentioned.
Got it. Thank you very much. And I'll jump back in the queue.
所以这些华尔街的也不太了解Upstart 的模式，其实。
Please go ahead.
Hey, thank you very much, and thanks for the details today. Wanted to go back on the secured funding, and I think you made the comment that there were some preferential terms that you were able to offer to them. I guess a couple of questions associated with that. Going forward, what would be the right level of mix or targeted mix for that group? And it sounds like you're planning to add more to that.
1/3这个之前就讲过的问题。
How much should we expect that you may have to harmonize at least some of those terms into other sources of capital?
Hey, James, this is Dave. Good question. So I would say, first of all, one of the comments I had made in my remarks earlier was that we would like to have, in any particular month, capital committed such that we can be cash flow positive as a business. So sort of a baseline of capital that we feel very good about being solid will be there, and that would be a pretty dramatic reduction in cyclicality. So that's, I think, what we would try to do. I generally think we are benefiting from the fact that we have very strong margins, in that we can share a bit of them with the preferred partner, and a preferred partner is one that is making a longer term commitment to us. So I think that's a structure that we would expect to have for the long haul. And I think it makes sense that if they're going to commit to you, you're going to make some special commitment to them. And there can, of course, also continue to be plenty of sort of at-will participants in the marketplace month in, month out. And we don't expect that to go away, which is a good thing. But I do think we want a significant fraction of the funding to be more long-term committed and getting a little bit of preference for doing that. And lastly, as we've said, I think we feel comfortable, given our margin structure, that we can afford to do that. The other thing I'll add is this is all, as Sanjay said earlier, entirely related to personal loans today. I think we will push for this kind of structure on other products as well. I kind of believe that secured products, or ones that are much primer, like the HELOC product, will have probably, I would just say, less of a need for it because they will just tend to be more normal, familiar products and ones that lenders lean toward even in more difficult times. So that's how we're thinking about it. I don't know if I think there will always be kind of we'll hopefully harmonize these types of agreements into a consistent structure. Sanjay said they're starting off a little bespoke by probably not hard to imagine that would happen. But over time, I think we would really like to almost programatize it so it's a little more structured. But I do believe there'll be sort of longer-term partners, and there'll be at-will partners coexisting in our platform.
Yeah. And then I appreciate all that, David. And then how are you feeling about the state of your cost base now on a run rate basis? I know that here in the June quarter, you're expecting to roughly be adjusted EBITDA break even now that those programs have been fully implemented. But should we take that to mean that you feel like you're at the right cost base, and that the kind of the first quarter would have been roughly the bottom from a revenue generation perspective, and that you can grow at least for the remainder of this calendar year on a sequential basis, or are there incremental actions that need to be taken? Just trying to think through kind of how you're seeing the business and its evolution from this point.
Hey, James, this is Sanjay. I think we're in very good shape. I think from a personnel perspective, I think we did what we needed to do in Q1, and we're past it. I think our workforce numbers are in very good shape now, and barring any dramatic reversal in the business and the economy, I think we will sort of grow from here. There's still more work to be done on the OpEx side. As Dave mentioned, there's sort of programs to sort of reduce, we're large consumers of compute. Our machine learning models require a lot of sort of training resources, and we want to get more efficient at that. Our engineering footprint, the resources we consume, can get more efficient as well. So I think that this will be an ongoing set of initiatives. But I think by and large, your model is right, which is I think we're at a good place. We can tighten up a little bit more, but we're sort of indicating that we think there's a nice path for growth from here on out. As we demonstrated before, our cost base is going to scale very efficiently with the top line, and it'll sort of provide nice margin materialization as we grow.
That's great. Thanks for that, Sanjay.
Thank you.
就是这个季度是最低了，往后应该就是从这个方面继续增长的问题，而且成本也不会再增加太多。
Good evening, gentlemen. Congrats on the quarter and on securing the $2 billion in funding. My question, I know in the past you've been asked about becoming a bank and not wanting to do that, which I can totally appreciate. My question for you, and I guess it kind of relates back to the funding as well. Would you consider like a warehouse type funding mechanism? And does any of your $2 billion is any of it structured in that kind of way where you pay a fixed rate and you hold more loans on balance sheet? Or is all that $2 billion that you talked about? Is all that $2 billion that you talked about purely arm's length outside off balance sheet financing?
Yeah. Reggie, yeah, that's generally what we would term forward flow commitment. So the loans that are purchased monthly by a third party, an outside third party. So that's what that is. It's not on our balance sheet. There's no warehousing on our side. They can be using, they could be leveraging on their side if they chose to, but that's separate from anything going on with us. Let me see, what was the other part of the question?
So would you consider warehouse? Is that also something that you would not do?
Yeah, we've had modest warehouse capacity for many years. So when the loans are on our balance sheet, to some extent, those are financed and it's more efficient use of our equity capital. But that's still, that's under that umbrella of the loan total. Sanjay said we aim to stay at no more than $1 billion on our balance sheet, and those tend to be warehoused, or at least some of them are. So we do use that for capital efficiency, but it's not a primary funding mechanism, just as our balance sheet ultimately is not a primary funding mechanism.
Got it. No,
the loans on our balance sheet, when we say we have $1 billion of assets on the balance sheet, that less than half of that is the actual loan equity of ours, the rest is finance. But we still consider that to be our balance sheet. It's really what we're interested in with the long-term arrangements is third parties as the risk engine, and they can finance as suits them.
Yeah, no, I appreciate that. I guess the crux of the question was, would you consider being more, I guess, balance sheet intensive? It sounds like you're comfortable with $1 billion. That's kind of where you want to remain at least for the foreseeable future. My second question, guidance. Very strong numbers. In particular, I guess the net interest and kind of fair value. I guess that implies a pretty sharp sequential improvement there. I was curious what was driving that, and if you could talk a little bit about the performance you're seeing of your loans that are held on balance sheet, loss rates and things of that nature.
Yeah, sure. This is Sanjay. So as far as the guidance, I would say that Q1 was the anomaly in a sense, which is normally you'd expect your balance sheet to have some modest positive income. We tend to hold our loans at fair value, so we mark to market. We don't use CECL accounting, and so when interest rates are going up, which has happened a lot in the last year, it's taken a toll on the valuations. Q1 in particular didn't necessarily have adverse sort of interest rate movements, but what it did have is we booked unrealized fair value marks that reflected a balance sheet transaction. Now, it was not a balance sheet transaction that completed in Q1, so that's why it's unrealized. But because it was a balance sheet transaction that we were anticipating, we were expecting, and we expected to close, early in Q2, we sort of reflected the economics of that transaction in Q1, and that will be in our disclosures. So I think you could think of that as of Q2 going forward, We're not really anticipating any large significant transactions beyond the one we've already accounted for. And therefore, I think what you're seeing now in our guidance for interest income just sort of reflects ongoing normality. It does, it's sort of like interest rate stability, no large transactions, and some modest income from our remaining balance sheet. So that's how I would think about the guidance. As for performance, I think the best way to think about it is in our investor materials, we generally display, what we're intending to do as a blended average across our platform with respect to gross return delivery and how we think each vintage is trending. And the simple summary is, vintages that are on our balance sheet from back in 2021 or 2022 are likely going to underdeliver as they are across the broader platform. I think anything as a certainly Q4 forward, so anything from the last 6 to 9 months are well on track to over-deliver in our opinion. And so the performance of our balance sheet will just reflect the underlying vintages that you see on the broader platform.
Got it. And if I could sneak one more in, on the take rate, you talked about, I guess, stronger economics. Curious, is there a way to kind of parse the impact of stronger pricing or origination fees that are paid by borrowers versus maybe what your partners are paying you? Was there any change there when you talk about better pricing?
I don't think there's anything necessarily more to parse there other than fees primarily borne by borrowers that are getting loans funded through institutions tend to flex up at times like this. So that's really what you're seeing. I mean, yield requirements are going up, loss expectations are going up, and also the fees going up. All of which we certainly don't love, but it's the reality of the economy we're sitting in that we have to play in. And we would really be happy to see all that reverse itself over the next year if we're so fortunate.
No, I got it. That wasn't clear, guys. I'm sorry. I've got a couple calls going on, so I didn't catch that part. That was primarily borrowers. Okay, thank you.
No worries.
Our last question comes from the line of Simon Clinch with Atlantic Equities.
Hi guys, I've got to jump back in the queue. Thanks for taking my question again. I'm just curious, going back to your the pace of your new model rollouts or updates through the quarter was pretty staggering. And I'll just, as someone who doesn't really know about these things, I was wondering if you could talk us through perhaps the risks and or challenges of that kind of pace of rollout and how to think about that in terms of the benefit going forward, because previously we hadn't needed that many rollouts to create significant benefits for you guys.
Yeah, Simon, it's a good question. It's important, I would just say, to state that we have different models in production for each product that we have. So there's 4 products, 2 auto products, a personal loan product, small dollar product. Each of them have related but different models that push to production. There's also models that are more focused on automation than the pricing, so things that deal with fraud and those kind of things. So, all across, I don't know exactly how many AI models, distinctive AI models we have, but it's quite a few, and those teams are working in parallel. So this isn't the same model being updated or retrained every 3 days. It's less than that. But there's a lot of them, and each one of them, generally are making some part of our product line that much better. So that's a pace which, a couple of years ago, we were probably maybe doing, one a month or so. So it's quite different.
That sounds a lot more sensible. Thank you.
Thanks, Simon.
This concludes today's question and answer session. I will turn the call back for any additional or closing remarks.
Just want to thank everybody for listening today, and as we've said, we're happy with what we've achieved in the first quarter. We're actually pretty optimistic about 2023, so thanks for sticking with us.
OK， 他的电话会议基本上就结束了。我简单说一下我个人的感想啊，其实因为还没有仔细看他的材料， 所以只是看一下他给的具体的大致的数字，以及管理层刚才在电话会里面透露出来的一些其他的信息我觉得总体是这样。一个数字上应该没有什么值得挑剔的，我相信明天的股价也会反映出来。不管现在是涨了多少，我觉得就是几个是我们之前特别关心的，尤其会员可能知道，就是说这个长期的资金有没有解决现在基本上是应该是说解决了，它现在有20亿2 billion， 就是20亿美金的长期的资金，就是这些资金，它在过去的几个月商量了之后，找到了华尔街的人，然后让这些人呢去承诺未来几年就是可以给他20亿美金，让他去做这个贷款，然后他们会把这些资金提供方会把这贷款放到自己的账上，然后接受利息。当然的代价就是说 Upstart 为这些长期资金要付出一点点额外的成本。他的 CFO 也讲了，他说因为我们的其实单位经济效益很好，就是我们其实利润很高所以他哪怕是这个为了长期资金比如说多给2个点3个点Upstart 仍然愿意做，因为其实它的利润非常丰厚，所以这是这个解决了。而且他还有他说他在 pipeline 就是说他现在这个20亿美金是已经谈完的，已经确认的，但是呢他还在跟别的家也在谈，所以这个呢只是现在的第一批未来的还会继续增加。我上次电话会里面他管理层讲是说他们希望长期是可以所有的资金当中有大概1/3是来自于这个长期资金，所以这个量应该是比较大的，所以这20亿美金应该是不够。而且管理层也讲了，他说我们是希望至少就是我们这个长期资金可以供我们公司这些运营，然后不烧钱，就是说哪怕所有的银行都停止了，其他的任何资金不进入，他只是靠他自己的这些长期的不会跑的这些资金，他也可以保证自己的收入，然后保证他有一定的利润，不会烧钱还有呢，就是 CFO 讲，他说这个长期资金都是之前没有跟我们有什么直接关系的那些伙伴，就是说他这些长期资金的来源不是现在的，多数不是现在的资金提供方，意味着说他这些带来的新的收入就是一些额外的收入，不是他不会吃掉你现在的那些已经有的收入所以这些完全是额外的新加的收入所以我觉得从长期资金这个方面应该是没有任何问题就是很多人之前担心我相信这个应该是不用了，所以这是长期资金的问题。然后另外一个就是汽车贷款的问题汽车贷款其实刚才我不知道他这个具体的 PPT 里面有没有讲，我还没有来得及看，但刚才的问题这些讲的并不多但是呢 CEO 一开始的时候有讲，他说我们其实汽车贷款我们现在也有一个渠道，然后准备开始发行我们的汽车贷款的上市这是我们之前也特别注意和担心的一个。所以因为这个他后面回答问题他也讲了，他说因为我们现有的这些刚才说的20亿的美金的长期的资金是主要为我们的主要的主营业务那些无抵押贷款，因为这部分呢就现在影响比较大，所以需要这部分来补充。但是呢他说我们如果是未来是汽车贷款或者是未来的房贷，这些因为是有抵押的，所以市场我们之前就讲过它是都叫资本市场，但资本市场对不同的贷款是有不同的态度的，所以你这些有抵押的贷款因为坏账很低，而且市场都很完善，所以呢这些通常不需要你有长期资金，就是你只要让别人能看到你这个汽车贷款从坏账上没有超出行业的平均，或者跟你之前预想的差不多那这应该是有多少市场就会吸收多少所以这是应该有个非常成熟的市场，你这部分大家都觉得风险是很低的所以我觉得这个我没有看具体的数字但是至少听他来讲说他这个汽车新车贷款已经基本准备好了。还有一个就是说他好像讲了一句他说我们要开始做房贷这好像也比之前我预想的要快，因为我之前认为2023年它是一个转型的是一个调整的一年，所以它可能新的产品可能要放慢一点，但现在感觉没有，它是新的产品照样就非常快速的推出 所以总体来讲，我觉得非常正面啊，就是这3方面的问题都基本上解决了。然后，考虑到这家公司现在市场是，除了卡瓦纳之外，它可能是被做空最多的公司，至少之一吧。它好像流通股当中有30%到40%是被做空的，所以呢，也不排除未来几天出现那个 short squeeze， 就是很多做空的一下看那股价涨了很多，被迫要做自己的那些清仓的操作啊，所以这个股价会有波动比较大，但总体肯定是往上嘛，这应该是没有什么悬念的，因为它这个季度是最差，管理层也讲了说，除非未来几个季度经济有突然的逆转，要不然的话，一季度由于季节性的影响，再加上它没有长期资金，所以呢是它的收入最低的一个季度，而且亏损也比较大因为它还有裁员什么都在一季度然后计入账。但是呢，从2季度，它现在给的指引是2季度收入比1季度有增长，而且呢调整过的 EBITDA 是正的是0，意味着说它不会再烧钱进入了一个比较平衡的阶段。那意味着从3季度、4季度，它就会第一个会继续持续增长，第二个就会有比较大的利润以及现金流。我相信它会重新开始回购甚至增加更大的回购也不排除这取决于3、4季度它的股价的在什么价位上。所以总体我觉得细节还要看我可能是现在去睡觉，今天下午希望把会员的视频做出来，然后 Affirm 没来得及看，不知道情况怎么样然后今天至少把这2期做完，然后如果大家有问题，会员请留言，然后我会今天、明天尽量把这些消化一下，因为它其实内容很多，因为很多新产品所以呢还有它的季报会最近几天也会发布所以这周也会比较紧张就是光是讲 Upstart， 我觉得它内容很多，所以我会尽可能的在周日的会员直播之前把所有的内容都看完消化透，然后希望给大家在会员直播的时候讲的稍微质量高一点，因为现在讲其实非常泛其实讲不出太多东西，只能是对财报以及电话会议上的一些比较基本的反应吧，好吧，谢谢大家。我知道会员可能有点不甘心，因为我还没有开这个聊天的功能，因为我现在这个不是会员的那个节目所以大家会员再等一下，好吧，谢谢大家，祝大家周3愉快再见。